Now is 3Fourteen Research co-founder Warren Pies. And Warren, it's great to catch up with you again here. I mean, one way to, I guess, read the market action so far this month as we kind of rush up to the top of a multi-month high is investors saying that you have to raise the probability, I guess, of a potential soft economic landing if you're kind of looking at the odds out there. Do you buy into that, or do you feel as if this is a fade?
Well, I buy into the idea that that's the narrative driving this market rally right now. So you can kind of trace it back to Fed Governor Waller's speech on January 20th. He gave an explicit guide to a soft landing and laid out a lot of hope there, and the markets grabbed hold of that. Personally, and within our firm, we're fading that. We think that a soft landing, it's still possible, but we put about a 20 to 25% probability on it. And last week, we wrote a big report on this. And really, we wanted to step back and challenge our assumptions and say, we're looking for a second half recession. What would it take for us to change our view and get a soft landing? So that's how we approached the question. And really, in our mind, there are two big factors for a soft landing. We need this, what we're calling immaculate disinflation. So we need inflation to continue heading lower without a recession. And then we need a hyper-reactive Fed. We think we're going to get number one. I think inflation's coming down. It's been a call of ours for a while. We're going to get rapid disinflation this year. I do not believe the Fed is going to be as reactive as it needs to be to get this soft landing just right. And so then to spin that forward, we really started to zero in on the housing market. I think that's ground zero if you're looking for a soft landing or a recession call, because housing's at the center of both of those things.
Yeah. Why do you think that the Fed has to be acutely reactive? And by that, I know you mean would have to get easier in terms of policy in response to inflation going down a lot. Why can't the Fed kind of keep rates around where they are, whatever the ultimate level is that they get to, and then just see how the economy handles it from there?
Well, a couple things. Number one, if you look at the Fed's, this gets a little academic, and I won't go too far down this path, but the Fed estimates that R star, which is the neutral rate of interest, where you would be balancing inflation and growth in the economy, is like 2%. And the real Fed funds rate, as we get this disinflation, is poised to shoot higher, way above that R star number. And really, the big takeaway is when that happens, policy gets really restrictive really fast. The Fed generally does not ease it without a recession. So you need a recession to prompt the Fed to cut rates enough to get that soft landing. Mm-hmm. The other big reason is housing affordability. So we've seen a lot of hope that housing has kind of bottomed here, and it just doesn't wash with the data. So I'm not a housing doomer. There's a lot of housing doomers out there. I think there is an undersupply out there in the economy, and there's a good demographic tailwind. But when I look at it, the average real house payment is $2,800 per month. And we always have topped out around $2,200 to $2,400 at the very top in the housing market. So we need to have housing affordability come down without a crash in house prices if we want a soft landing. That requires the Fed to be reactive, I think.
Yeah, obviously mortgage rates on the 30-year down about 1 percentage point from the highs, but obviously would need to probably keep in that direction to make a dent in the affordability picture. Where does it take you in terms of sort of tactically in the stock market or other markets like bonds?
Yeah, I'm basically stepping away from the stock market at this point. We outlined with you last week and to our clients for a long time this rough range that we're watching, 3,600 to 4,000 on the S&P 500. I think if you go back and check what I said, I think we're going to need a break above that range to suck the most people in. I just saw a technician on the show before mine, and he was saying, you know, things are looking like a buy. We're getting breadth thrust. To me, classically, this is going to suck people in the top. You need an excuse to buy and get long. When I look at it, short-term debt, you're being compensated to sit this market out and wait to see what happens. And because we think we're going to get a hard landing, it's going to be a recession in the second half of the year, that's how we're playing it. We're going to be fixed income over stocks, and really I want to be shorter term in that fixed income picture. I mean, if you think about it, you can get almost 5% in a money market fund or short-term debt. We're at 4,000, almost 4,100 before the sell-off today in the S&P 500. You need to get at least double that. You have to be guaranteed at least double that of the volatility you're going to see in the stock market in order to justify a long position. So you're basically betting on getting close to all-time highs here if you're getting long. So no, I don't like the risk reward of the equities.
Yeah, certainly a different hurdle rate with yields up where they are versus past several years. Warren, great to talk to you. Thanks very much for the time today.
Thanks for having me.